Listen carefully. What I'm about to share with you isn't speculation. It's not a guess. It's a pattern that's been screaming at us for weeks, and most investors are too busy watching the noise to see the signal. If you're holding silver or thinking about it, the next 5 minutes could change how you approach this entire trade. Let's get into it. The setup. Nobody's talking about. Right now, silver is sitting in the most interesting position it's occupied in over 4 decades. But here's what's strange. The conversation around it is completely backwards. Everyone's arguing about whether we saw a top. Everyone's debating whether the rally is over. And while they're busy fighting about the past, they're missing what's building right in front of them. Here's what actually happened. Silver didn't just move up. It didn't just break resistance. It shattered a psychological barrier that has haunted this metal for generations. And then something fascinating occurred. Instead of collapsing back under that barrier like it did in the past, it's holding. It's digesting. It's building something. Think about what that means. When a market breaks a ceiling and refuses to fall back through the floor, that's not weakness. That's recalibration. The market is telling you that the old rules don't apply anymore. The old reference points are obsolete. We're in a new regime. The volatility. You're seeing is not what you think. Now, let's address the elephant. Yes, silver has been violent. Yes, it's been whipping around. Yes, if you're watching the screen every day, it feels like chaos. But volatility isn't the same as direction. Volatility is just energy. And right now, that energy is telling us something critical. When an asset moves this violently while maintaining its elevation, it means there's a fight happening underneath. There's a war between old positioning and new reality, between paper contracts and physical demand, between people who think this is 2011 all over again, and people who understand this cycle is completely different. Here's the key. Volatility doesn't kill bull markets. Complacency does. Bull markets die when everyone's comfortable, when everyone's certain. When the room is full and nobody's questioning anything. Does that sound like where we are right now? Not even close. Right now, most investors are terrified. They're skeptical. They're waiting for permission to believe. That's not the top. That's the middle innings. The industrial demand story. Everyone's ignoring. Let's talk about something that doesn't get enough attention. Silver isn't just a monetary metal. It's not just something you buy when you're worried about inflation or currency debasement. Silver is an industrial workhorse. It's embedded in the technology that runs modern civilization. Solar panels, electronics, medical devices, water purification, 5G infrastructure, electric vehicles. The list goes on, and here's the problem. We're not producing enough to meet the demand that's coming. Think about the solar build-out happening globally. Think about the electrification of everything. Think about the infrastructure spending that governments are committing to. All of that requires silver. Not paper silver, not futures contracts. Actual physical metal. And here's where it gets interesting. Unlike gold, where central banks hold massive reserves, silver gets consumed. It gets used up. It doesn't sit in vaults waiting to come back to market. Once it's in a solar panel or a circuit board, it's gone. That's a structural deficit building in real time. Now combine that industrial pull with monetary demand. Combine it with investors who are starting to wake up to inflation risk. Combine it with geopolitical instability. What you get is a metal that's being squeezed from both sides. And when you squeeze something from both sides, it doesn't compress. It explodes. The mining sector anomaly. Here's something that should make you stop and think. While silver has been making historic moves, mining stocks have barely reacted. Read that again. The companies that dig this stuff out of the ground, the companies whose profits multiply when metal prices rise, they're sitting there like nothing's happening. Now, some people look at that and say it's bearish. They say the smart money doesn't believe. But that's exactly backwards. When miners lag the metal, it usually means one of two things. Either the market doesn't believe the move yet, or it hasn't figured out the trade yet. And guess what happens when the market finally figures it out? When analysts start running the numbers and realize that these companies are printing cash at current metal prices, that's when things get interesting. That's when you see the catch-up trade. And catch-up trades in mining stocks don't happen slowly. They happen in weeks, not years. Think about the mechanics. A mining company has fixed costs. When silver was at $40, they made a certain profit. At 50, that profit margin expands. At 70, at 80, the leverage is exponential. A 20% move in metal can translate to a 100% move in earnings. That's not hype, that's arithmetic. So why haven't miners moved yet? Because the money hasn't rotated. Because the narrative hasn't clicked. Because most investors are still fighting the last war, worried about 2011, worried about false breakouts, worried about everything except what's actually happening. The currency backdrop, nobody wants to discuss. Let's get uncomfortable for a minute. Let's talk about the dollar. Not because the dollar's dying tomorrow. Not because we're heading into some hyperinflation apocalypse, but because confidence is shifting. When you have debt levels this high, when you have deficit spending this aggressive, when you have political incentives pointing toward more spending, not less, the math gets difficult. You can't cut your way out. You can't tax your way out. The only way out is through inflation. Managed inflation, controlled inflation, but inflation nonetheless. And when people start to internalize that, when they start to realize that holding cash means watching purchasing power erode, they look for alternatives. They look for stores of value that can't be printed. They look for real assets. Gold gets most of the attention in that conversation, but silver is gold's volatile little brother. And when gold moves, silver tends to move harder. Not always immediately, not always in a straight line, but eventually the correlation reasserts itself. And when it does, silver doesn't tiptoe, it runs. The supply side nobody's modeling correctly. Here's a question that should bother you. If silver demand is rising, if industrial consumption is accelerating, where's the new supply coming from? You can't just decide to mine more silver overnight. These projects take years to develop. Permits, infrastructure, capital, time. And even when new mines come online, they're often higher cost. The easy deposits are gone. The high-grade ore is depleted. What's left requires more energy, more labor, more capital to extract. That's a rising cost curve meeting rising demand. And that's exactly the recipe for higher prices. But there's another angle. A lot of silver comes as a byproduct of other mining. Copper mines, lead mines, zinc operations. So silver supply is partly dependent on the economics of completely different metals. If copper prices fall and copper mines shut down, silver supply contracts, even if silver prices are high. That's a strange dynamic. It means silver supply doesn't respond to silver demand the way Economics 101 would suggest. There's a lag. There's friction. And that friction creates opportunity for massive price dislocations. What history actually tells us and what it doesn't. Everyone loves to reference 1980. Everyone loves to reference 2011. And sure, there are lessons there. But here's what most people miss. The context was completely different. In 1980, you had interest rates at 15%. You had a Federal Reserve willing to destroy the economy to kill inflation. You had Hunt brothers trying to corner the market. That's not our world. In 2011, you had QE starting to taper. You had the European debt crisis. You had China slowing down. Again, different world. This time, we have structural deficits that aren't going away. We have energy transition creating massive new demand. We have geopolitical fracturing. We have central banks that have proven they'll print rather than let the system break. Those are different dynamics, and different dynamics produce different outcomes. So yes, study the past, but don't assume the past is a blueprint. Markets rhyme. They don't repeat. The paper versus physical disconnect. Here's something that should make you pay attention. The futures market and the physical market are starting to show cracks. Spreads are widening. Delivery times are extending. Premiums are sticky even when spot prices pull back. What does that tell you? It tells you that paper and physical are diverging. It tells you that contracts are plentiful, but metal is tight. And when that divergence grows, something has to give. Think about what a futures contract is. It's a promise to deliver metal at a future date. But promises are only as good as the entity making them. And if everyone holding contracts suddenly wants delivery, if physical demand overwhelms the system, those promises get tested. We're not there yet. But we're moving in that direction. And the closer we get, the more dangerous it becomes to be short. The behavioral trap most investors fall into. Here's the mistake that costs people fortunes. They wait for certainty. They wait for confirmation. They wait for everyone else to agree. And by the time that happens, the move is over. Markets reward early action and punish late conviction. They reward people who can read structure and ignore noise. They reward patience and discipline and emotional control. Right now, most investors are emotional. They're scared by the volatility. They're haunted by past failures. They're overthinking every pullback. And that emotional state is exactly what creates opportunity for people who can stay calm. Think about what silver has done. It broke a multi-decade ceiling. It held above that ceiling despite aggressive selling. It's showing resilience in the face of forced deleveraging. That's not bearish. That's consolidation. That's the market building a platform for the next leg. What's coming in the next 6 months? Now, I'm not going to give you a price target. I'm not going to tell you silver's going to 100 or 150 or 200. That's not how this works. But I will tell you what to watch. Watch whether silver can hold current levels through year end. Watch whether miners start to wake up in Q1 earnings. Watch whether physical premiums stay elevated. Watch whether mainstream media starts covering the metal trade. If those things happen, if those dominoes fall, we're looking at something bigger than most people are prepared for. And we're looking at a rotation that could define the next several years. And here's the thing. You don't need to be perfect. You don't need to time the exact bottom. You just need to be positioned before the crowd arrives. Because once the crowd arrives, once everyone's talking about it, Once your neighbor is asking you about silver stocks, that's when the easy money has been made. The risk you need to acknowledge. Let me be clear about something. This is not a guarantee. Markets can do anything. Silver could absolutely pull back further. It could test lower levels. It could frustrate everyone for months. But here's the question you need to ask yourself. What's the risk of being wrong versus the opportunity of being right? If silver consolidates, here and then moves higher, what's the upside? If it pulls back and you get a better entry, what's the outcome? Risk management isn't about avoiding risk. It's about taking intelligent risk where the reward justifies it. And right now, the risk reward in silver and silver miners looks asymmetric. The final question. So here's what I want you to think about. Everyone's asking whether silver topped. But that's the wrong question. The right question is this. Has anything fundamentally changed? Has industrial demand reversed? No. Has supply suddenly surged? No. Have central banks stopped printing? No. Have deficits shrunk? No. Has geopolitical risk disappeared? No. If none of the fundamental drivers have changed, if the structural story is still intact, then what you're seeing isn't a top. It's noise. It's volatility. It's the market shaking out weak hands before the next leg. And if that's true, if the structure is still bullish, then the opportunity isn't behind us. It's right in front of us. We just need the courage to see it and the discipline to act on it. So that's the message. Stop watching every tick. Stop obsessing over daily moves. Zoom out. Look at the structure. Look at the fundamentals. Look at what's actually changing versus what's just noise. Because the people who make generational wealth aren't the ones who chase. They're the ones who recognize patterns early and have the conviction to stay positioned even when it is uncomfortable. Silver is uncomfortable right now. That's exactly why it might be the best opportunity on the board. Think about it. Do your own research and decide where you stand, because this story is far from over.